I said earlier on that a company is a separate legal entity. It has to be treated as such. What you can't do is simply write out cheques from the company bank account or make internet transfers into your own account at will. There has to be a formal structure in place. The payment has to be described as something. It has to fall into a particular category. So the way you get money out of the company is twofold. Firstly, the company can pay you a salary for the work that you do for it. And secondly, it can distribute dividends. I think most people understand a salary because they've worked for a salary before. They have a code and the employer operates PAYE, and so the code gives a tax-free amount and tax is deducted from the rest along with national insurance. The employer remits those deductions to HMRC and pays the employee the net. Exactly the same system works for a contractor taking a salary from his own company. Dividends, on the other hand, are a distribution of profits, and that's profits after corporation tax. So when a company makes a payment of a dividend, tax has already been accounted for. So the payment of a dividend is a net payment to a contractor, very much in the same way as he might receive interest from a bank account. So the dividend is net of basic rate tax. The contractor himself only has a further liability on that dividend to the extent that he's a higher rate taxpayer. Let's go through what might be an optimum strategy for a contractor, and let's assume turnover is £80,000. We'll forget about the advantage of the flat rate VAT scheme, and we'll forget about normal administration and travelling expenses. We'll assume that those two items cancel each other out. So we'll concentrate on £80,000 income, all available to go to the contractor and of course in taxes. Contractors, like everyone else, often have spouses or partners, and very often that person is either not working or they're working in a part-time capacity. In those situations, the company can be structured so that the spouse or partner has some interest in the company, and that interest may be as an employee receiving a salary or as a shareholder receiving a dividend. And what we can do is we can advise on an optimum strategy for that person by considering all of their circumstances. So he can receive a salary from his company, but so can his wife. And if they set salaries at around about £10,000 each, that will leave a profit in the company of something like £59,500. And after corporation tax of about £12,000, they're going to have about enough to pay out £24,000 each in dividends. So in that example, they'll get about £19,500 in salary, then they'll each incur liabilities to employees' national insurance of about £250, so about £500 in total. They'll get £48,000 in dividends. That makes £67,500 out of the £80,000, and that's a return of over 84%. Child benefit for many years has been a universal benefit, but from January 2013, it's restricted for couples where one partner has total income from all sources in excess of 50,000. The way it's restricted is a tapering as income increases from 50,000 to 60,000. So many contractors before they became contractors earned salaries in permanent employment above 50,000, so they saw that their child benefit was either tapered or completely eliminated. By setting up as a contractor and using a limited company, you can plan for your total gross income to be less than 50,000, and once again you're entitled to child benefit. I think all contractors need to be aware that a dividend will be illegal unless it's paid from profits. So if no reserve is made for corporation tax, then their dividends are illegal, and they will in effect be treated as loans made to the director, and there are tax consequences involved in that. So a prudent approach needs to be taken. It's not a case of having an accurate forecast, but some calculations need to be made. Some money needs to be left aside for corporation tax. So for instance, given that the present rate of corporation tax is 20%, if a contractor looked at building up a bank balance over the year that equaled 20% of his turnover, he would certainly have enough money left to pay his corporation tax. And therefore, the dividends that he's taken out would be within that limit. They would be paid out of profits, they wouldn't be illegal. Loans are often taken, sometimes they're planned, sometimes they're by default. Some contractors fail to get it in their head immediately that money should only be taken from a company in a formal way as salary or dividends, and they simply write out cheques. Those are loans. As I say, sometimes a loan is planned. A loan from a company other than a listed company or a PLC is not illegal, so loans can be taken. There are, however, tax considerations when loans are taken. There are two particular taxes to be concerned about. The first is that if a contractor has a loan from his company, he has a benefit in kind. If he had a loan from a bank instead, he'd have to pay interest. If he has a loan from his company, then on the face of it there's no interest charged, so there's a benefit to the extent that he's saved interest. HMRC apply a benefit if the loan at any stage in the tax year exceeds £10,000. The benefit in kind is calculated at a notional interest rate which is currently 4%, and a simple way around this is for the contractor to actually account to the company for interest, so that the benefit in kind would be nil. So if the contractor accounts for interest at 4%, then there's no benefit in kind and no tax charge. I would emphasise that this is 4% on the total loan, not the amount by which it exceeds £10,000. That's the first tax charge. The second tax charge is a corporation tax charge. Quite complex, quite difficult to appreciate, but if a company makes a loan not specifically to a director but to a participator, and a participator is someone with a material interest in the company, so a shareholder, and of course contractors tend to be both directors and shareholders, so these things get termed directors' loans, but strictly speaking they're participators' loans. So if a company makes a loan to a participator, and that loan is still outstanding 9 months after the end of the company's year, then corporation tax needs to be paid on that loan, or the balance still outstanding, at a rate of 25%. Now, that tax charge itself then becomes repayable at a point in time after the loan itself is repaid. I do hear from time to time stories of people who set up a limited company, take a contract, take some money out of it, build up about £10,000, then dissolve the company, have it struck off, and set up a new company and do the same again. And they're looking at the fact that, broadly speaking, with a small salary, if they take more than £30,000 out as dividends, they're going to be paying higher rate tax. But if they dissolve the company and make a capital gain of about £10,000, instead of taking that £10,000 as a dividend, then they can use their annual capital gains tax exemption and not pay any capital gains tax. It sounds wonderfully simple, but unfortunately there's tax avoidance legislation going back to the 1960s which counters this. And if you dissolve one company for the purpose of avoiding income tax, and you form another company at the same time, then the distribution you take from the dissolved company, rather than being taxed as a capital gain, is taxed as a dividend. Now, you've probably spoken to many contractors who've done this, and nothing's happened to them. I have to say they're simply living in blissful ignorance. Neither they nor their accountants fully appreciate what they're doing, and I can't advise anyone to do that. It's an accident waiting to happen.